Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's dive right into the saga of Presidio Property Trust, ticker SQFT. This is one of the most volatile and frankly perplexing equities on the exchange right now. We're seeing the stock locked pretty tightly, currently in the low $3 range. We're talking $3.20 to $3.60 by late December 2025. And that marks a staggering decline, over 70% since that massive capital raise back in July. But, the price action is really only half the story. The reason this is a debate is the trading profile. We're seeing daily FINRA short volume ratios that regularly surge past 40, sometimes even 50%. So the central question for any investor is, what's the primary pressure point? Is this valuation, the sustained decline, driven fundamentally by corporate financial engineering, dilution, capital structure decisions, or is it overwhelmingly a function of opaque market structure and, just volatile retail sentiment?
My position is that the structural financial decisions, specifically that warrant dilution, are the mathematical drivers that define the stock's maximum potential and, therefore, its current collapse.
See, I come at it from a fundamentally different angle. While I fully acknowledge that the company's financial decisions created the vulnerability in the first place, the day-to-day experience of the price suppression, the extreme volatility, the failure of any upward momentum to stick, that is overwhelmingly a product of market plumbing. I believe the mechanics of off-exchange trading, particularly that market maker short volume internalization, combined with the extremely reactive psychology of a low-float retail investor base, those are the immediate forces preventing any genuine price discovery and actively suppressing the stock on the lit market.
Let's ground this in the financials, though, because the math provides a kind of hard cap on any speculative thesis. My core thesis is really simple. The price degradation is an unavoidable consequence of management prioritizing solvency and, critically, the Series D preferred stock, ticker SQFTP, over any real value creation for common equity. And the company's commitment to that capital stack preference is crystal clear. They continue to pay monthly cash dividends on that cumulative Series D preferred stock, which, importantly, is trading around $15. Now, while this shows some operational cash flow, it permanently signals that the common shareholder is only investing in a residual value proposition. The liquidation preference on that Series D stock sits so far above where common equity could ever hope to be realized in the near term. We are talking about prioritizing tens of millions in preferred liabilities before the common shareholder sees a single penny of true equity.
I agree that the preferred stock establishes a massive hurdle for long-term returns, but that is the horizon. I see why you think that dictates the daily price, but let me offer a different perspective on the price ceiling mechanism. The most toxic structural event wasn't the dividend payment. It was the mechanism that just flooded the market with cheap supply, the warrant wall.
Precisely. The single most impactful event was that July 2025 registered direct offering. Management slashed the warrant exercise price to $12. And that wasn't an arbitrary number. It was the price that ensured the institutional buyers had a guaranteed, highly lucrative profit opportunity once the stock approached double digits. This action fundamentally capped the upside. Anytime the common stock price even nears $12, warrant holders are just overwhelmingly incentivized to exercise and immediately sell the new shares. It creates this massive structural supply overhang that acts as a mathematical permanent ceiling.
The warrant structure is the ultimate governor, I agree. But the mechanism that allows that supply to be distributed so efficiently down here in the $3 range, that's the structure of the daily trading. The daily price action is defined by market fragmentation. Let's look at those FINRA short volume ratios again, over 50% sometimes. That high short volume signals that the majority of the trading is being done off-exchange, in dark pools. And while the short interest, the actual directional bets against the stock, remains low, around 4.7%, this high short volume is the classic signature of market maker internalization. MMs sell short to immediately fulfill retail buy orders, giving the appearance of liquidity, but critically preventing any upward price pressure on the Nasdaq limit book.
I think we have to link the anticipated supply to the current price, though. The price weakness we're seeing right now, sitting near 320, is not random. It is a direct market reaction to the supply that became effective with the December filings, specifically the S11 registration statement and the subsequent Form 424b3 prospectus supplement. These documents clear the selling stockholders from that July offering to just release millions of shares onto the public market. The market is pricing in this imminent confirmed supply shock. That is structural finance beating down the price, not just market plumbing.
That's a compelling point about the official supply release, but it only reinforces my view that the mechanism dictates the pain. I mean, consider the profound illiquidity here. The average daily volume often languishes in the low tens of thousands. So given the small float of just over 1 million shares, when retail traders who are fueled by these short squeeze narratives initiate buying, they create these temporary violent spikes, the classic pop and drop. We saw that volatility in mid-December. It rocketed from 304 to 438 and then immediately collapsed. These rapid rallies are critical, but they only serve as efficient liquidity events for warrant holders or other distressed sellers to offload their positions. The market structure literally transforms buying enthusiasm into an opportunity for dilution.
And this brings us right to our first major point of contention, the intent versus the effect of that high short volume. I see why you think market structure is the immediate primary driver, but that high short volume, as you noted, is transactional hedging. If institutions truly believed this company was going to zero, we would see short interest well over 20 or 30%. The low short interest of 4.7% suggests they aren't actively betting against the company, they're just managing their internalized flow. The real risk is the structural supply created by the warrants, which is a mathematical constant independent of daily market maker activity.
I'm sorry, but I just don't buy that the technical intent of the short volume absolves its destructive effect. Whether a market maker is selling short directionally or just hedging their flow is completely irrelevant to the investor who bought at 350 and watched their order just disappear without moving the price. The effect is identical. Those trades do not contribute to positive price pressure on the lit exchange. I come at it from a different way. The off-exchange mechanism acts as a critical facilitator for the structural decline. It's the grease that allows warrant holders to sell into this neutral to negative environment so efficiently without crashing the entire bid stack and jeopardizing the company's ability to raise capital again. The mechanism allows for a smooth, protracted, and ultimately destructive dilution process.
Okay, so if we accept that the market plumbing facilitates the exit, then we have to talk about the fuel that keeps this market functioning, the flawed retail thesis. That's an interesting point, though I would frame it differently. The continued existence of a bid is predicated on fundamentally flawed financial analysis circulating widely online. We see it constantly. Retail traders consistently miscalculate the intrinsic value because they fail to properly subtract the massive liquidation preference of the Series D preferred stock. They just focus erroneously on summary figures like total equity and convince themselves this is some kind of deep asset play.
But this flawed thinking is precisely what sustains the current market. I'm not convinced by that because that misinformed buying behavior is a market driver in itself, arguably the most important one below the $12 cap. That belief in deep value leads to this predictable averaging down behavior. As the stock drops from 10 to 5 to 3, these traders keep buying, creating a constant, reliable stream of liquidity flowing into the downtrend. This, combined with off-exchange execution, is exactly what gives institutional sellers, the warrant holders, the exit ramps they need without causing a complete price collapse. The institutions are selling into continuous, if misinformed, enthusiasm, which the market structure is engineered to accommodate.
So the retail audience, by misinterpreting the capital stack, is basically essential for the company's slow-motion dilution? You're arguing that retail ignorance is a corporate asset.
In this specific low-float, high-dilution scenario, absolutely. The low short interest shows institutions aren't aggressively betting against the company. But the extremely high short volume shows market structure is actively optimizing the distribution of shares for the institutions who are exiting into that retail bid.
Let's shift to the technicals, because that's where structure and sentiment really meet. The stock is oscillating around 320. I maintain this pressure isn't just a technical phenomenon, it's rooted in supply anticipation.
specifically the S11 and the 424B3 filings. They became effective in December. And for clarity, the S11 registers the shares, and the 424B3 is the final supplement that officially makes those restricted shares free trading. The market is pricing in this massive influx. If the major support level of 304, the 52-week low breaks, it's going to be because that structural supply completely overwhelmed the bid. It'll be a fundamental supply crisis.
That's a compelling argument. But have you considered the short-term reality? The immediate stability near 320, despite everyone knowing about the supply, suggests a momentary technical capitulation. We have to look at the oscillators. The RSI is at 33.8, bordering on oversold, and the stochastic is deep in oversold territory at 13.97. The selling intensity is demonstrably stretched right now. The technicals suggest the market is due for a reflexive bounce, a temporary relief rally, setting the stage for violent volatility regardless of the long-term structural weakness. Technicals dictate the timing of the next wild swing, even if fundamentals define the floor and ceiling.
But those temporary bounces, as you've basically conceded, they only serve as maximally efficient selling opportunities for those holding the cheap supply from July. The $12 warrant wall prevents any sustainable appreciation, no matter how oversold the stochastic gets. Look, management is playing a game of corporate survival. They're prioritizing preferred obligations, listing requirements, all of which mandate continuous low-cost access to capital via dilution. The common shareholder is, well, an afterthought in a high-stakes shell game aimed purely at solvency.
And that shell game needs an audience, which brings us to the role of management in manufacturing sentiment. We haven't even touched on the significance of the Acorn Management Partners engagement, announced December 1st. Management actively hired a firm to tell the story to the market. Now, this either validates your point, that the fundamentals are so weak they have to rely on pure narrative, or it validates mine, that management knows that volatile retail sentiment, not pure fundamentals, provides the transactional environment they need for their dilution strategy to succeed.
I lean toward the former. Hiring Acorn suggests a desperation born of fundamental weakness. They know their balance sheet decisions, the preferred dividends, the extreme dilution, make the stock mathematically unappealing. They need a narrative to mask the reality. They are not manufacturing the price, they're manufacturing the demand necessary to meet the impending supply.
I'd argue that hiring Acorn validates the role of market structure and sentiment as the active price component. They are essentially saying the current market price is not reflective of their assets. However debt-laden they are. They are actively seeking to leverage this fragmented, low-liquidity environment. If every retail buy order were contributing fully to the lit market, they wouldn't need a consulting firm to tell the story. The price would move. Because those orders are internalized, offset by short volume, they have to hire an external firm to fight the structural headwinds that are suppressing value.
Ultimately, we agree on the cause of the underlying weakness, the structural debt and the warrant overhang.
Yes, but we disagree on the active ingredient in the daily pain. While the fundamentals created the ceiling and the long-term slide, the extreme volatility, the lack of follow-through, the feeling that rallies are immediately stifled, that's all amplified by a low-liquidity market dominated by opaque off-exchange mechanics and erratic speculators. The daily pain is a function of market plumbing, not just balance sheet entries.
And I will maintain that the fundamental reality, the creation of massive, cheap supply via repriced warrants, and the precedence of the preferred stock, that dictates the stock's maximum potential and its overall trajectory. The upside is mathematically capped by the warrant wall, making the squeeze thesis basically impossible. The valuation is a consequence of financing decisions first, and market structure second. The structure only facilitates the inevitable.
The saga of SQFT it's a complex intersection of corporate survival tactics and modern market structure. It's a phenomenal case study in how capital raises in distressed, low-float companies are executed in today's fragmented market.
Understanding the full picture really requires discerning which force, the structural supply from the warrants or the transaction mechanics of off-exchange trading, is the more active component at any given price level.
And which is the reason why the stock, despite having the same fundamentals, trades at $10 one day and $3.20 the next. We leave it to the listener to weigh which force they believe holds the greater immediate influence on Presidio Property Trust's valuation in this turbulent environment.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.